Hello and welcome to the Business Standard Morning Show. I'm Nazia Iqbal. It's the 22nd of June 2023 and here are the top stories for the day. What are the implications of IndiGo's 500 plane order? Is free power to households hurting industry? Is it time to diversify to global markets? And what is Gift Nifty index? India overtook the United Kingdom to become world's fifth largest economy last year, and it is projected to grow at a rate of over 6% in the coming decade. So like others, Indian airlines too are racing to tap the demand from growing ranks of middle-class consumers. The country's largest airline, IndiGo, has inked a pact to purchase 500 planes this week. It has pipped Air India to set the new record for the biggest single purchase agreement in history. So, what does this order mean for IndiGo and its future strategy? And what does it mean for the Indian civil aviation sector? Pashwa Kumar brings you the answers.
India's largest airline, IndiGo, has just placed the largest ever aircraft order in aviation history. It is buying 500 passenger jets from European plane maker Airbus. The deal was struck on June 19th at the Paris Air Show. The order is for narrow-body aircraft such as A320neo, A321neo and A321XLR, and the deliveries will take place from 2030 to 2035. The IndiGo deal overshadows another historic large-scale order placed by another Indian airline run by conglomerate Tata Group. In February this year, Air India had ordered 470 planes. Of these, 250 are to come from Airbus and 220 from Boeing. While the IndiGo deal is estimated to be worth about $50 billion going by the most recent Airbus list prices, the actual cost will be significantly lower thanks to substantial discounts. So, what is the rationale behind the size and timing of IndiGo's deal? On the sidelines of the Paris Air Show, IndiGo CEO Pieter Elbers said that the airline would double in size by 2030, indicating that it would have a fleet of about 625 by then. According to Elbers, the latest order will provide IndiGo a planning horizon of over 10 years with regards to the flight network and fleet composition, while also securing the supply pipeline for the next 10 years amid supply chain challenges and delays. Meanwhile, IndiGo will receive deliveries of 480 aircraft till 2030 from its previous orders with Airbus. So, IndiGo's historic aircraft deal clearly suggests that the airline is looking at expansion. IndiGo has tripled its fleet from 100 in 2016 to over 300 at present, with the 2019 closure of Jet Airways helping on the growth front. IndiGo also seems to be enjoying a similar advantage from the grounding of another airline, Go First. It registered its highest ever domestic market share of 61.4% in May. The IndiGo deal also comes after the February order by Air India, which had last year revealed a 5-year transformation plan to triple its domestic market share to 30% by investing in new aircraft. Later in 2022, the Tata Group announced the merger of Vistara with Air India, with the deal expected to be completed by March 2024. This might have also been on the back of IndiGo's mind as it went ahead with the Airbus deal. Against this backdrop, what does the latest deal reveal about IndiGo's domestic strategy and the direction of the larger Indian civil aviation market?
An order like this, of course, means that the airline is going to expand, and the expansion will of course be from tier 1 large cities to tier 2 and tier 3 cities, but also a lot of these smaller cities, which aren't small if you look at it from a global perspective, they are going to build themselves into larger sort of cities with greater connectivity. So yes, of course, they'll continue to expand domestically and also internationally.
Indian aviation has, for the first time, a long-term growth strategy, a very confident capacity, and the right balance sheets to support this capacity and future long-term growth. So IndiGo, we see that this order is for both new inductions as well as replacements. So IndiGo will continue its growth strategy. There are currently a lot of airports in India which are underserved. So IndiGo will again try to utilize those spaces as well as expand into international routes.
Coming to the international front, the February Air India order included a mix of narrow body and wide body aircraft. Air India is also looking at growing its international routes significantly. Meanwhile, IndiGo's latest order did not include wide body aircraft. However, IndiGo is reportedly exploring a separate purchase of such planes, with both Airbus and Boeing competing. So, what are the implications of the latest deal for IndiGo's international market strategy?
They have a significant number of Airbus 321 XLR aircraft on order. Now, the XLR is yet to get certification, but there are these test birds flying around. So you see, irrespective if they get the wide body aircraft or not, that's a different story, and we'll have to wait to see how this pans out. With the XLR, at least they'd be able to connect most of Europe. They might not be able to go to London per se without payload restrictions, in my opinion, but the vast majority of Europe can be connected with the A321 XLR. So IndiGo is going to expand further internationally, not just into Europe, but also other parts of the world. They'll go east. They'll also expand in Southeast Asia. And, the XLR is going to be the aircraft of choice.
Based on the orders that they placed, we know that they are targeting international expansion. IndiGo currently, if you look at the split, is about 23% international, 77% domestic. In the next 8 to 10 years with this deal, their goal is to have in the next 8 to 10 years about 30% international split. And beyond that, they want to make it about 40-50%. So that's the immediate goal.
On a sobering note, persistent engine issues have reportedly brought down Go First. Multiple IndiGo aircraft have also been grounded due to issues allegedly related to Pratt & Whitney engines. While IndiGo has opted for CFM engines instead in previous orders, the engine selection for the latest one will be done in due course. So, could the engine issue rear its head again in the future?
Well, you see, there's just no way, in my opinion, to mitigate risks, from new technology. All these new engines that are available in the market, which are, of course, more fuel efficient and, and they save you tons of money. This is new technology. And yes, there have been issues with Pratt & Whitney engines. And then there is supply chain issues which have aggravated those issues further. I mean, it all completely depends on how these supply chain issues are addressed over the next couple of years.
Ultimately, what challenges will IndiGo face in realizing its ambitions through the latest deal?
The thing with aviation is you can place all these orders, but the fact of the matter is no aircraft are being delivered on time. All deliveries are delayed due to supply chain issues. Airlines don't have seats that can go into their brand new aircraft. So ordering aircraft is one thing. Getting them delivered on time is a complete different ballgame. And it is widely sort of expected that these supply chain issues aren't going anywhere for the foreseeable future.
Air India on June 20th sealed the $70 billion February deal with formal purchase agreements. There's clear bullishness surrounding the world's third largest aviation market, which could see the number of domestic passengers more than doubling to 350 million by 2030, from 144 million in 2019. However, experts warn that recent airline failures show that the sector remains volatile, making engine and supply chain troubles all the more challenging.
She'll soon be quoted on the front page. Business Standard.
After these two back-to-back historic aircraft deals, the challenge for Indian aviation is that it is staring at a duopoly now. Meanwhile, another sector critical for the economy is facing its own set of challenges. Parties in several states rode to power by promising cheap or free electricity. At least 27 states and union territories are now providing subsidized electricity to consumers, but it comes at a cost. Some of it is being borne by the industries in the form of cross-subsidy. So, is free power for households hurting industry? Tariq Ahmed finds out. The recently revised power tariff rates in Karnataka came as a shock to the industry and households alike. Electricity prices across the state increased by 2.8 rupees per unit for those using more than 200 units per month. For the households, Karnataka had announced free electricity till 200 units of consumption per month. But the industry and trade bodies of Karnataka are feeling the heat of this power tariff hike. Industries across the state complained of electricity bills going up from 30 to 70% for the month of June and demanded the government to reconsider the tariff hike. One of the contributing factors to the higher tariff for industries is the cross-subsidy. The National Tariff Policy 2016 prescribes cross-subsidy among various segments of electricity consumers, which raises the power tariff for industries and businesses. The National Tariff Policy has limited the maximum cross-subsidy to 20% of the average cost of supply. So the discount that households get is compensated by charging commercial users slightly higher than the cost of supply. Anne Joseph from Prayas Energy Group said that industry consumers pay less cross-subsidy than commercial consumers, and the problem that industry consumers are facing is originally coming from other sources.
The role of cross-subsidy in looking at compensating the discoms for the expenses is not as significant as subsidy. So then, what is really paining the industry? I think the issue itself is that what it costs the utility to supply power itself is at about 8 rupees per unit in most states. And obviously, over the years, reliability and other services provided by the utility have also increased. But at the same time, this is also the period when renewable energy and other power is available at competitive rates through third-party contracts or through markets. So as compared to the utility, many consumers can avail much more competitive supply through other arrangements, through alternate arrangements. So the cost of supply itself is non-competitive as compared to other avenues. And that is what is really hurting industry. The fact that they're unable to avail this competitive supply because of procedural hassles or because of lack of clarity, or because those are the kind of things that really need to be addressed.
Compared to captive and open access options, the cost of power from distribution companies is high and non-competitive. This has been driving industrial consumers away from state-owned distributors and pursuing options like open access and captive power plant facilities.
If you look at in some of these large states, the industrial tariffs have now crossed the 8 rupee, 9 rupee mark, and commercial tariffs are upwards of 9, 10 rupees. So that definitely hurts the cost of production of these industries, and that is why we are seeing a lot of these industries adopting renewable energy through open access, where you'll be able to get a cheaper source of power even after paying all the open access charges, because of the significant improvement in the competitiveness of the tariff offered by the wind and solar projects. A lot of industries are moving towards this open access and moving a portion of their power procurement to this. This enables them to meet their, obviously, the ESG obligations as well as reduce their cost of power procurement. That has been a challenge for the industry in many states.
Experts say DISCOMs should introduce reforms in planning and procurement and unbundle the tariff rates for services like wires and energy transfer ecosystem.
We move away from this conversation of cross-subsidy to a conversation of how do we increase competition and alternate supply options for consumers, and how do we really unbundle or rethink tariff structures for utilities itself, such that many of the services that we are providing to these consumers can be charged at cost.
It is also important to use innovation and bring in renewable energy resources to reduce the dependence on cross-subsidy for the poor and government subsidy for the distributors.
I think essentially we need to first look at what are the different innovative ways in which we can reduce the cost of the utility or the distribution company supply itself in the first place. So some innovative measures are being tried in states. For example, agriculture is the category which benefits a lot from, let's say, the cross-subsidy revenue that's coming from other categories and also from government subsidy. But recently there have been initiatives to reduce the cost of supply to agricultural consumers. So actually, solarizing many of the agricultural supply would reduce the cost significantly. In fact, it would even halve it in many states, which would reduce the cross-subsidy dependence and the subsidy dependence significantly. So leveraging on new technologies, can we think of measures to reduce the cost itself and therefore reduce the cross-subsidy requirement?
Industries and commercial users have been facing issues of higher tariff rates because of cross subsidies and rising supply cost. Experts point at the need to deploy innovative measures to bring down power tariffs, and that means moving to affordable sources of electricity like renewables for the major power discoms in India. Free or subsidized electricity has hit the discoms too, and affected their ability to pay power generators on time. Moving on, global markets have staged a smart recovery this calendar year, outperforming Indian stock markets by a wide margin. However, given sputtering economic recovery in China and recession fears lingering around the US economy, how should investors approach global markets? Nikita Vashisht takes a deep dive in our next segment.
Despite underperforming the world indices so far this calendar year, the benchmark S&P BSE Sensex claimed a fresh all-time high of 63,588 level on Wednesday, June 21st. Thus far in CY23, Indian headline indices have advanced around 4% each. By comparison, major indices in the US have surged up to 30.5% this year, while those in Europe and Asia have surged up to 29%. Analysts believe this turnaround from last year's correction reflects receding concerns around sticky inflation and tighter monetary policies. Deepak Jasani of HDFC Securities, for instance, observes that global markets have recovered as the recession worries are now partly discounted in the prices. The US Federal Reserve kept interest rates unchanged on June 14, pausing for the first time since May 2022. The Reserve Bank of India too has kept rates steady for 2 straight policies. Thus, if we are at the end of rate hike cycle, should investors start diversifying to global markets?
Though India is a focus market for a lot of global investors, Indian investors can definitely explore the option of putting a small portion of their assets into global stocks or funds. Smart micro investing in select stocks or funds abroad have the possibility of matching or beating the returns earned on Indian indices.
In terms of economies, Rahul Arora of Nirmal Bang suggests this allocation strategy.
If you take a look at the US, for example, the recession should have actually already set in, but it hasn't quite. The jobs data is still extremely strong over there. China is opening up, so that's seeming like a very interesting trade as well. And the FI flows have just about returned to India over the last couple of months in a very material way after the Fed and the Reserve Bank of India have paused. So I would actually look at having a reasonably diversified portfolio. I think some amount of the allocations should certainly be made to the United States, some definitely to China. And I think if you're looking at the emerging market basket as a whole, I think India is probably your best bet. So I think maybe as an allocation, maybe about 50% still India. And I think of the balance 50%, I'd probably say 25% split even between China and the US.
Analysts suggest risk-tolerant investors allocate up to 20% of their assets across global economies, while the percentage could be 5% for risk-averse investors. Today, on June 22nd, markets will react to US Fed Chair Jerome Powell's testimony to the Congress.
He's making plans for an early retirement. Business Standard.
Staying with the theme of markets, we all know what Nifty is. The Nifty 50 and Bank Nifty indices are most tracked by traders and are barometers for market sentiment. Starting July 3rd, market participants will hear another term more often. That is Gift Nifty. Sounds interesting? But what is it? Sammy Modak helps us understand it. Gift Nifty is not a new concept. It was already very popular in its earlier avatar, SGX Nifty. Nifty derivatives contracts traded on the Singapore Exchange or SGX were referred to as SGX Nifty. Trading in these contracts will now take place in Gujarat International Finance Tech City or GIFT City under a special arrangement between SGX and the National Stock Exchange, which owns the Nifty branded indices. The arrangement is popularly known as NSE IFSC SGS Connect. NSE IFSC stands for NSE International Financial Service Center, the exchange's arm operating out of GIFT City IFSC. Essentially, all the trades emanating from SGX will be routed and executed at GIFT City. The NSE IFSC SGX Connect will become fully operational from July 3, 2023. All fresh contracts will be issued for GIFT Nifty instead of SGX Nifty. Meanwhile, all outstanding SGX Nifty will be fully transferred to NSE IFSC at GIFT City for order matching. In 2018, Indian bourses terminated data sharing pacts with their foreign counterparts in a bid to prevent export of domestic markets. The move could have technically put an end to Nifty contracts getting traded at SGX, as the Singapore bourse couldn't have used the Nifty nomenclature. This led to a lengthy legal dispute between NSE and SGX. Both the exchanges were engaged in arbitration proceedings under the Arbitration and Conciliation Act. In the interim, Nifty derivatives will be allowed to be traded on the SGX. The solution emerged out of the arbitration was the NSE IFSC SGX Connect program. NSE gets a license fee from SGX for use of Nifty branded indices. Nifty trading has gained popularity on SGX, where it is one of the most traded derivatives contracts. At a recent analyst call, NSE MD and CEO Ashish Kumar Chauhan said the entire revenues generated from GIFT Nifty trades will go to SGX for the initial few years. Thus, SGX will be able to protect its revenues as long as trading in GIFT City remains as popular as SGX Nifty. Trading in GIFT City will be cheaper from a tax and transaction cost point of view compared to onshore Nifty. However, domestic investors will not be able to trade GIFT Nifty. Only those registered with SGX will be allowed to deal in the index. Anyway, GIFT City IFSC is like an overseas jurisdiction from an Indian investor's standpoint and is primarily aimed at foreign participants. The GIFT Nifty index, however, will provide cues for Indian investors on how the domestic markets could react to global events when our home markets are shut.
Nation's trusted bank, SBI, the banker to every Indian.
Interestingly, trading in GIFT Nifty is likely to take place for 22 hours a day. Well, that's all we have for you today. We will be back with more news and analysis in our next episode. Stay tuned. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.